Hi, my name is Scott Gibson with Beneath the Surface. I'm here with Lawrence Roulston, publisher of Resource Opportunities. Hi Lawrence, thanks for being with us.
Great to be here, Scott.
Now I wanted to talk to you first of all about the news that Bernanke put out in terms of QE3. What are your comments on QE3 and the effect it's going to have?
Well, it was a very aggressive announcement. You know, it certainly signals that the market is, or that the Fed is prepared to do whatever it takes to get the economy back going again. I'm not sure that, you know, this idea of putting more and more cheap money out into the financial system is really going to have a really big impact on the jobs market. You know, they've been doing this for a couple of years now. It hasn't had a big impact. There's lots of free money. Interest rates are already at a very low level. And the really important point is American corporations are sitting on over $2 trillion of cash right now. And it's not that they're not investing because of a lack of cash, they're investing because of uncertainty. Uncertainty with regard to the political situation in the United States, of course the election coming up, and also the global financial outlook. So, you know, although it's a positive thing, it certainly had a big impact on investor sentiment immediately after the announcement. We saw the gold price up $38. And, gold is now up more than $200 since the middle of July. So investors are certainly looking at this announcement from the point of view of more cheap money into the market. It's going to lead to further debasement of the currency, and exactly the same process going on the other side of the Atlantic. Of course, the Europeans are doing exactly the same kind of thing, different form, but the net result is the same, that they're injecting more and more and more money into the financial system, and that money is being created with no real tangible backing. So in effect, they're continuing to debase the currencies, which if you've got a massive debt load is a great way to go. Mm-hmm. So investors are obviously aware of this. Their gold price, as I said, up $38 on the announcement of QE3, $200 in the last couple of months, and likely to continue moving higher as investors digest this idea that the currency is going to continue to depreciate over time, and gold providing that kind of stable, safe haven in the face of declining values of currencies.
So what you're saying is sort of good for stocks, good for gold, not necessarily overly influential or being good for the economy or for the unemployment situation in the United States.
The unemployment situation in the United States, I think, is due more to structural problems than it is to lack of liquidity. There's a huge mismatch of skills. There's a lot of unskilled workers that are looking for jobs, and have been looking for jobs for a very long time. But on the other hand, there's high-tech companies and a range of other employers that can't find the people they need. So it's a skill mismatch more than it is a structural change. Obviously, the economy is not growing at the pace that people would like it to grow at. It's positive, albeit slow. So the QE3 is not really going to materially impact the economy, certainly not in the near term. But it's provided investor sentiment, and that's really what's driving the markets these days, is investor sentiment more than it is fundamentals.
And what do you think that does for the gold price going forward, not just short term in the first few days, but the next few weeks and months?
Well, my message on the gold price is it's folly trying to predict a particular price on a particular day any time in the future. Mm-hmm. But if you look at the trend over the last 10 or 12 years, from $250 in 2001 to $1770 today, and just sort of put a band around that long-term gold trend, projected out into the future, and that's where it's likely to continue to move toward.
The trend is still intact.
The trend is absolutely intact. And in fact, if you look more closely at the trend, you'll see, obviously a continued steady uptrend with spikes and pullbacks. But from the beginning of 2009, the slope of that graph has turned up significantly in the face of the growing economic uncertainty.
And what about the effect in terms of the particular stocks, large caps, mid caps, or the ones that follow more closely the juniors?
Well, as the gold price has been trending up over the past couple of months, the producing companies have begun to move up in value. They're still trading at a significant discount to net asset value on average. So there's still room for those, the producers to increase in value just to catch up to the current gold price. The juniors are grossly undervalued. We've seen action on some of them recently, but many of them are still way undervalued. And I'm talking about the good companies with a real asset, with cash, with management that know what they're doing. And of course, there's a whole other subset of quote unquote gold companies that are probably still overvalued, even though on the surface they might appear to be very cheap.
Yes. Well, thanks for being with us, Lawrence, and talking about your comments on the QE3 announcement, the effect that's going to have gold and gold stocks.
Okay, thank you.
Again, that's Lawrence Roulston, publisher of Resource Opportunities. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.